Banking vocabulary. Acceptance house, account, current account, deposit account, statement of account, overdrawn account, accrued interests, advanced against shipping documents, apply for a loan, arrears of interest, ask for security, auction, auctioneer, audit an account, backup line, balance, bank, banking establishment, banker, banking, bank charges, bank clerk, banker's commission, bank holiday, bank of issue, bank of international settlements, bank manager, bank rate, bank vault, base rate, bear interest, bill of exchange, bonus, bonuses, bona fide, borrower, bullion, buck, call money, rate, cash, cashier, carry interest, charge interest, cheap money, checking account, check, clearing bank, clearing house, collateral, collateral security, collecting of checks and bills, collection agency, coin, commitment, counterfoil, cover caution, credit, cash credit, consumer credit, export credit, frozen credit, import credit, secured, unsecured credit. Creditor, credit balance, credit department, credit facilities, credit side, credit status, credit worthiness, credit worthy, cross-check, current account, deadline, debtor, debentures, deed, default, to default, defaulter, deferred interest, deposit, saving deposits, time deposits, to deposit money with a bank, deposit account, deposit currency, depositor, deposit slip, discount credit, discounter bill, dishonored draft bill, documentary, dollar area, drawer bill, draw money, drawee, drive-in bank, due date, endorse, equity, estate, export credit, factoring, full due, fee, fixed interest, yield securities, float, float alone, foreign exchange department, forge, for and on behalf of, fraud, fund, funding, fundraising, funds, gain, gyro, give notice to, grant a loan, grant an overdraft, guarantee, hoard, hoarding, honour a bill, hot money, import credit, increase the interest rate, indebtedness, interest, accrued interest, deferred interest, outstanding interest, interest bearing, interests on arrears, International Bank for Reconstruction and Development, International Monetary Fund, Investment Bank, invited subscription to a loan, IOU, issue, to issue, issue in bank, the issue was oversubscribed, legal tender, lend on overdraft, lender, letter of credit, lien, loan to loan, loan agreement, loan department, loan repayable by, loan on collateral, loan on mortgage, loan on personal property, on movables, loan on real property, loan sharking, lodge money with a bank, LIBOR, London Interbank offered rate, make out a cheque, medium-term loan, merchant bank, money on deposit, mortgage to mortgage, mortgage deed, mortgage finance, mortgage loan, first or second mortgage, notice, NSF, open cheque, open an account, outstanding, outstanding interest, overdraft, overdraw, overdrawn account, overdue, paying in slip, payable at site, to pawn, to pledge, portfolio management, postal cheque, postal savings bank, principal, promissory note, quid, raise a loan, raise, reduce the interest rate, rate of exchange, ready money, receipt, to redeem, redemption, reminder, remittance, repay, reimburse, refund, revolving credit, run a deposit with a bank, safe, safe custody of securities and valuables, safe deposit department, savings deposit, savings bank book, savings department, secured credit, secure a loan, security, securities department, solvency, solvent, special drawing rights, stale check, startup credit, statement of account, strong room stub, subscriber, swap agreement, swing line, syndicate, teller, traveller's checks, transfer, term deposit, terms of a loan, underwriting department, unit trust, unsecured credit, usurer, usury, venture capital, wicket, withdraw money, World Bank yield interest. So historically speaking, banks can be traced back to the days when religious people lent their assets, often in the shape of perishable goods, to people who needed them in return for a promise to be paid back the goods under consideration, along with a slight increase in the amount lent. This was meant to be a fee of sorts to pay for the service provided. Also, religious people used to collect deposits from the public who thought that their belongings would be safest in temples or shrines. Today, the banking sector still performs such tasks, but no longer does it in the name of God or a divinity. Still, in the same way that the exchange of goods was central in religion, bankers have now become key participants in economic activity. Banks can be roughly divided in accordance with the type of customers they cater for. Commercial banks, also called high street banks, are those which develop services tailored to the general public, such as the use of a checkbook, the provision of a credit. They are privately owned, profit-seeking institutions. They accept funds from customers, which can be readily used for the use of a checkbook, have extensive branch networks, and are major participants in the clearing system, i.e. the settling of debts between banks. They inject large amounts of money through the economy through checks, payments made by direct debit, standing order, or credit cards. When a check is made out, the payee sends or takes it to his bank, which credits the amount to his account and sends the check to be presented to the drawer's bank through the clearing system. The clearing system is operated by the Clearing House in London. It adds up the total amount each bank owes to each other bank and reconciles the difference in the bank's accounts with the Bank of England. The check is then sent to the drawer's bank, which debits the drawer's account. Sometimes the drawer's bank may decide not to honour a check if there is not enough money in the drawer's account or the check is incorrectly written. Other ways of paying include plastic money, i.e. all types of plastic cards used instead of cash. A typical bank card can do three things. It can guarantee a check, it can obtain cash from the automatic telling machines, also called cash dispensers, cash stations, cash points. It can pay for goods by electronic funds transfer at a point of sale. A fourth use for plastic cards is to give customers credit when they purchase goods or services. These credit cards are issued by credit card companies such as Access, American Express, Visa. Some of these are owned by banks. Technological developments have resulted in ever more sophisticated cards. Most of them now carry a microchip with account information on the holder, information about previous transactions, all of which can be viewed at inquiry terminals. Apart from offering their customers means of payments, commercial banks also lend them money. In some countries, some banks specialise in providing loans geared to a specific public. Among them are Building Society in the UK, Savings and Loans in the US, which gather the savings of millions of short-term savers and then lend them to home buyers. In the UK, for instance, building societies account for most of the mortgage loans taken out for house purchase, while in other countries, commercial banks provide the same service. So you have automatic teller machines, cash dispensers. Base rate is the prime lending rate or the best rate at which banks agree to lend money. Certificate of deposit is a debt instrument issued by banks. Clearing is a method adopted by banks to settle their mutual indebtedness. Collateral is the property offered as a guarantee. Correspondent banks, they're banks which maintain accounts with each other. A credit line is the American equivalent of an overdraft agreement. Credit rating is a would-be customer, whether individual or company. It's the assessment of the risk a bank or financial institution runs on granting a loan. Credit status of a person or company is their financial standing. Credit worthiness is the assessment of an individual, firm or other institution's capability of repaying loans. A current account is a type of bank account the general public is most familiar with. Documentary credit is bank credit based on the provision of correct shipping documents. Electronic banking is a new revolution in the speed at which society adopts electronic banking. Tomorrow's world is already here today, and even now we can pay with our telephones. Factoring is a financial service whereby a firm sells its debts. FDIC is a Federal Deposit Insurance Corporation. Fund is made up of money held on deposit for a certain purpose. And the Glass-Steagall Act 1933 drew a sharp line between commercial banking and investment banking. Installment is the money paid in regular amounts of regular intervals, for instance when paying back a loan. Interest is the payment made by a borrower for the use of money. Interstate branching is the right for US banks to open branches in other states. Loan sharking is lending money at exorbitant interest rates, very high interest rates. McFadden Act of 1927 prohibits banks from operating outside of the state where the head office is registered. That's in the US. M&A Department is Department of Investment and Merchant Banks dealing with mergers and acquisitions. The mortgage is a debt instrument by which the borrower gives the lender a lien on his property as security for the repayment of the loan. A non-bank bank is financial institutions that are involved in banking activities but are not banks. A NOW account is a negotiable order of withdrawal account, interest-bearing bank account. Open market operations are a tool of monetary policy used to regulate the money supply. An overdraft is a bank account from which money has been overdrawn, means you haven't got the money in your account. Overdraft facilities are an authorization given by a bank to a client to withdraw more money from his/her account than is currently deposited. The pawn shop is a pawnbroker lends money against security of personal property pledged in his keeping. A PIN code is a personal identification number. Prime rate is originally the interest rate charged by banks to their most creditworthy clients. The rating agency are firms that evaluate the creditworthiness of banks and financial institutions and even states. The best ranking is AAA. Rescheduling of a debt is the lengthening of the maturity of the loan to make it easier for the borrower to meet his or her obligations. Revolving credit is the agreement between the bank and its client whereby the specified maximum of a loan is automatically maintained over a specific period. Savings account is a bank account in which the account holder pays money not to be spent for some time. S&L, saving and loan associations, are also called thrifts. They're savings banks. A security is an asset given by a borrower to a bank against a loan for an overdraft. A debit is to effect the necessary operations for the regular repayment of a debt. Shipping documents are documents covering an export consignment. Spread, this refers to the difference between the cost of the funds and their lending rate. Standing order mandate is an agreement on the part of a customer whereby his or her bank is to make regular payments to another account. Statement of account is the list of debits and credits which is printed out at regular intervals. A swap denotes an exchange of currencies by monetary institutions. A SWIFT is the Society for the Worldwide Interbank Financial Telecommunication. Syndicated loan is a very large loan which is shared out among several banks. Systematic risk, the threat that the failure of a bank or financial institution will trigger a chain reaction or domino effect involving the collapse of a whole banking system. Tombstone is an advertisement issued by investment banks in connection with a public offer of securities. Universal bank, a bank that carries out all types of banking operations. An unsecured loan, a loan against which no collateral or security is pledged. So here you have some phrases, so you can pause on the slide until you've learnt them all properly. Another one. Next to last one. And the last one. So thank you for learning all the vocabulary about banking.